Hey friends, so Johnson & Johnson, this is the number 2 position in my portfolio by value. It is huge in my dividend stock portfolio. I have a huge decision to make right now because they are splitting off Kenvue, their consumer products division. Kenvue, it's already trading publicly. And now J&J is offering existing shareholders like myself the opportunity, if I so choose, to exchange J&J shares for Kenvue shares. And so this would be a tax-free transfer to my understanding, and I have to make a decision here what I'm gonna do. I wanna share in the video today what's happening. I wanna share some statistics behind both companies, and I wanna share my process on how I decided what I'm going to do. So let's start with what's happening. Check it out on the screen right now. This is what's happening precisely. It's called a split off. Johnson & Johnson has already really split off this other company, Kenvue. It's already trading under KVUE, and they currently own 89.6% of the outstanding shares. Now, they want to reduce their stake by 80% at least. And so what they're saying is, hey, current shareholders of J&J, if you want, you can swap all or a portion of your J&J shares for Kenvue shares. And to sweeten the deal, Johnson & Johnson is saying, investor, if you opt in, what we're going to do is we're going to boost the value of your J&J shares by about 7%. So you kind of get a 7% discount, if you will, on the Kenvue shares if you decide to swap J&J shares for Kenvue shares. It's expected to be tax-free, and it's expected to close on August 18th at midnight New York time. My understanding is that's the absolute cutoff when an investor like myself can decide, hey, do I want to participate or not? Now, this is a weird situation. I think back in the day when investors like myself were looking at this consumer division spin-off, or they're calling it a split-off, we were thinking that it would be a little different than it is actually looking to be. We just thought, hey, we'd get shares in Kenvue, we'd have shares in J&J, the company would do all of that. Great. But now the company has taken a different path, and they're really making the investor decide, hey, do I just want to have J&J shares? Do I want to swap some of those so I have Kenvue shares as well? Or do I want to swap all of my J&J shares, if there's enough shares available in this program, all of them for Kenvue shares? And so it's a little confusing because investors have a decision to make. Well, when I have a complex decision, the first thing I want to do is just look at the numbers, look at the metrics. And so as you can see on the screen right now, I want to share both J&J and Kenvue. What do these stocks look like? How do they compare? How do they contrast? You can see on the screen right now that J&J is a $169 share price, whereas Kenvue, it's really cheap by share price. It's only $23.53. And they are both off the 52-week high, but you can see that J&J, it's only off 6.6%, whereas Kenvue is off a pretty staggering 15.4%, which is pretty big given that it just started trading recently. Then again, with IPOs, things can happen, share prices can be volatile, so it's not too concerning. Now, thankfully, I have 2023 EPS estimates and 2024 EPS estimates for both. You can see those on the screen. I use the EPS estimates to back into forward PEs, or price earnings ratios, to see which one is cheaper, which one is more expensive. You can see that J&J is trading for a PE of 15.72 forward for this year, and Kenvue, by contrast, is at an 18. You can see next year, on a forward basis, J&J's forward PE is just under 15. It's in the high 14s, whereas Kenvue, it is still in the 18s. And you can see just off the bat there, Kenvue is more expensive than J&J. This is something, quite frankly, that bothers me a little bit because J&J, in my opinion, is a faster growing company. They have the pharmaceuticals, they have the medical devices. Kenvue is just consumer products, consumer packaged goods, if you will. CPG tends to be a little bit of a slower growth industry than these really innovative medical technologies that J&J is creating at the core company. And so even though it's growing quicker, at least I believe it will be growing quicker, the PE is lower. Now, that's going to be because some of the risk probably that is embedded in J&J, and I'll share some of that later. But off the bat, I like how J&J's valuation is looking versus Kenvue's. But let's keep going. As you can see on the screen in front of you right now, the next thing I want to share is just dividends. Kenvue has already initiated a dividend of 20 cents per quarter. JNJ has one of $1.19 a quarter. And so I annualized the dividends, and let's look at the yields. Now, J&J's yield is 2.8%. Kenvue's is 3.4%. And so I guess Kenvue wins on immediate cash flow. For dollars invested, same amount in either company, Kenvue will drive more immediate cash flow. That being said, I would say it comes at the price of payout ratio. J&J's payout ratio is really low at only 44%. Kenvue's is 62.5%. And so payout ratio being higher at Kenvue, I expect future dividend growth to be a little slower at Kenvue. Whereas payout ratio is lower at J&J, I expect future dividends to grow quicker at J&J. And so I would say, yes, Kenvue can provide more immediate cash flow, but it could be at the expense of future dividend growth. Now, I don't have dividend growth statistics for Kenvue because it just started trading, but J&J's has been 5.75% per year on average for the last 5 years. Now, the last thing I want to share on this screen is market capitalization. J&J is currently $439 billion company, whereas Kenvue is a $45 billion company. If I take 45 billion and I divide it into 439 billion, you can kind of get a sense of how they compare. Basically, if it were just one company, Kenvue represents about 10% of market capitalization. And so about 10% of the former J&J. The former J&J, before it did this split off, if you will, before that happened, Kenvue would be probably about 10% of its value. So off the bat, what that tells me as an investor is, hey, if I did participate in this split off, probably the maximum I would try to do would be about 10% of my J&J shares. And the reason I would do that is because I'd want to preserve that unified company look. I wouldn't want to be overrepresented in Kenvue because before it did this split off, I had about 10% of the value there in Kenvue. So I kind of look at it that way, that would be the maximum I would do for my personal situation. Now, of course, in the video today, I'm just speaking to my personal journey. This is not investment advice. I will have my disclosures, disclaimers at the end of the video and in the description below, as I always do. But I want to say, everyone's situation is so different. And so next I'm going to go into the framework I used to make my decision. I'm going to share with you what I decided, but I want to be clear that this is what works for me. But everyone out there needs to make up their own mind and speak with your financial advisor before making any financial decisions, because I am just going in from what works for me. By the way, if you enjoy the video so far, please don't forget to click the like button. It really means the world to me. Anyway, let's do it. As you can see on the screen in front of you right now, the next thing I want to share today is the matrix, the process that I use to compare and contrast these two companies. And I believe I have 10 different points of comparison. And so if you're at home trying to figure out, hey, what should I do? At least this would hopefully be a starting point to ask these same questions of yourself and try to stack rank the relative importance of these different metrics. The first one I already went through, but I just looked at valuation, and I highlight in yellow the winner, at least for my own personal situation. And you can see J&J wins because it offers a much better value. And I like to invest for value. I like to get the most amount of value for my dollars invested. And I feel that Kenvue, not only does it have a higher PE, but I presume their business is going to grow slower. And so even if I got a little boost on my J&J, that 7%, I look at that as a moment in time. And it's not enough to compensate for the higher valuation of Kenvue. The next thing you can see on the screen is dividend yield or immediate cash flow. I invest for dividends. I just shared over on Patreon today, actually, how I have turned off dividend reinvestment for the vast majority of my holdings, but I am still reinvesting dividends on some of those holdings. But I'm using that cash flow right now. I'm using it to rebuild the emergency fund. I'm using it for selective investment or reinvestment, mainly into SCHD and other opportunistic opportunities. And I'm using some of those dividends to help pay bills. And so I need a lot of cash flow. And so as you can see on the screen in front of you right now, I made a surprising highlight here. You could argue, and this is why I'm saying this is a very personal process, but I highlight J&J. Yes, the dividend yield is lower, but I'm kind of highlighting this looking 5 years out, I really think, given the lower payout ratio, given the possible dividend growth ahead, that yes, the dividend yield, the immediate cash flow, it's lower at J&J, but I still think it's going to win. And that's why I highlight that. But in the short run, look, yeah, Kenvue has higher cash flow off the bat with the 3.4% dividend yield, but I would be surprised over long periods of time, given their higher payout ratio and their slower general business model, that they would surpass J&J on yield. And so I did kind of highlight J&J here, even though they're not the winner on day one, just because I think they will be the winner on year 5. Now, the next one is market cap. I think this is important to realize as a dividend investor in particular who buys and holds dividend stocks forever. We live in a winner-takes-all society. It was just announced actually with the U.S. government debt being downgraded that J&J is actually a stronger credit rating right now than the U.S. government itself. This is incredible. Now, Kenvue, by contrast, is a respectable $45 billion company, so it's still huge, but it can't compete with J&J's status. Overall, J&J has a really special status. So I would say right now, J&J wins there too, for me at least, as a dividend stock investor who wants to buy something that's going to be around in another 30 to 50 years. Now, of course, Kenvue, I would say, is probably going to be around that long as well. It is such a special company. It's part of J&J. I wish they didn't even split it off. I wish they didn't do that. I wish it was all one company because I love the company that way, but I have to make hard decisions here. I have to make a decision. Do I go just J&J? Do I do a little bit of Kenvue, or do I do all Kenvue? Of course, I'm not doing all Kenvue, but I'm really trying to decide here, should I take some of my J&J and put it over into Kenvue in what is appearing to be a tax-free transaction? You'll know at the end of the video, but put in the comments below right now for fun what you think I'm going to decide. I already actually I foreshadowed my decision over on Instagram stories, by the way. Check out the pinned comment. I linked to my Instagram there, but let's keep going. As you can see on the screen right now, I have a few more criteria to go through. The next one is just portfolio simplicity. I already have 37 positions. J&J wins. If I just leave it all in J&J, it's better than introducing Kenvue into my portfolio because I don't want more complexity. More positions is more complexity. And so the next factor that I want to go into is legal risk. To my understanding, J&J the core company is going to keep all the legal risk related to the talc powder, the baby powder in the US and Canada. Kenvue should be shielded from that risk. I believe they've been indemnified by J&J for legal risk related to the talc powder, the baby powder. And so for an investor who really doesn't want an overwhelming amount of risk, I would say the single most exciting thing about this split off is the opportunity, tax-free mind you, and to get an immediate higher yield to trade out of that risk. Because my understanding is that J&J is indemnifying Kenvue. Also, J&J carries risk related to the opioid epidemic. Kenvue presumably would not have such risk because they are just dealing with consumer packaged goods. And so the single biggest line of thought that I had to think through hard before making my decision was this very topic. Do I want to go forward with this company that has presumably superior dividend growth, superior long-term yield on cost, this amazing credit rating, better than the US government? Or do I want to take this opportunity, especially now as I rely on cash flow more than ever to pay bills and for other reasons, do I want to swap out into this Kenvue stock, which de-risks the portfolio? That is a hard decision to make. Put in the comments below how you look at the risk. And I think this is going to be answered differently by so many different people. But I highlight Kenvue here. And also what I would say, it's almost like a double or triple highlight. I've been highlighting J&J, J&J, J&J throughout this whole thing so far. But what I would say is this element of risk, Kenvue wins, and that category alone is a really important category. It has extra weight. And so I had a hard decision to make, but I have 5 more criteria to go through, as you can see on the screen in front of you right now. The next one is portfolio risk. And so I went through legal risk, but now let's talk about portfolio risk. I have a lot of concentration in J&J. It's the number 2 largest position in my portfolio. It's a staggering position. More concentration in J&J is more risk. Whereas if I decide to split off some of my shares into Kenvue, or all of them, but of course I wouldn't do that. I just couldn't see myself doing that. More diversification is less risk. A more diversified portfolio has less risk. And so on the risk categories, as you can see on the screen, boy, Kenvue is really winning, but I want to keep going. Pride of ownership. This is kind of a silly metric, but what I would say is having a lot of money in core JNJ, that means something to me. That carries weight. It's been my largest position for a long time, and now recently it was surpassed by Starbucks. But this stock means something to me, whereas Kenvue, do I really care about that or not? Not really. I don't have pride of ownership behind that. And if I take some of my JNJ shares and split them off into Kenvue, it reduces the weighting of my JNJ. And just seeing the account balance of JNJ being lower, it affects me. I know this is a silly metric, but for me as a long-term buy and hold forever investor, it does matter because I have to stay committed to what I'm doing. And I have a lot of commitment to JNJ, and keeping the money all in JNJ, it keeps me focused. This is one of the stocks where I continue to reinvest dividends, and I'm not going to turn reinvestment off. And so that was a factor in my decision. As you can see on the screen next, I want to go through a few more metrics, points of comparison here. But the next one is just portfolio diversification. We already know I de-risk the portfolio by putting some of it into Kenvue because more diversification is less risk. But let's just look at my portfolio and categorically where I am invested. I have 11.8% in healthcare, 14.5% in CPG, and 14.9% in CPG food. I already have a lot of CPG, and so I give the win here, the yellow highlight, to JNJ, because I could stand to have stronger allocation right now to healthcare. I don't want to put more allocation in CPG. You could say I'm overweighted in CPG. And so from this standpoint, from a categoric diversification standpoint, yes, I'm probably better off leaving it in J&J. Now, this is a little bit in contrast to what I said earlier on just portfolio risk. Of course, portfolio position wise, more positions is more diversification, less risk. And so you have to weigh both of these. I had to weigh both of these. Next one is discount. Of course, J&J loses on this. Those who participate in the offering essentially get a 7% discount on Kenvue shares. Tax consequences, they both win. There's none if I keep all J&J, and there is expected to be none in the tax-free split off if I so choose to participate. So summing all of this up, what am I going to do? I have decided just to leave it all in J&J. I just could not bear to take away from my number 2 largest position in my portfolio. I could not bear to swap shares of J&J for Kenvue. It's a complex matrix. The number one reason I would swap shares if I did go that route for Kenvue would be to mitigate legal risk, because J&J does have legal risk. But the reasons to stay with J&J overweighted that for me in my personal situation. And those reasons really were the low payout ratio, the higher growth rate I believe the company will see, the higher growth rate I believe the dividend will see, and just the fact that it's one of the largest positions in my portfolio. It's the number 2, and it is that way for a reason. They have a higher credit rating than the US government. I believe this is the best dividend stock, or at least one of the best dividend stocks of all time, but I don't see Kenvue in that same light. So that's where I'm at. Put in the comments below, please, what you're deciding in your personal portfolio if you own J&J. If you don't own it, put your opinions down there below. I would love to get a lot of feedback from the community because, again, everyone's situation is different. It would be so fun to see what others are doing. Before you go today, also, please don't forget to subscribe. I have new videos on the way all the time. All right, everyone, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm just sharing my personal journey here on YouTube for fun and entertainment. Before you go out and make any investment decisions, please consult your licensed financial advisor first. I'm just sharing my journey here for fun and entertainment. It's possible to lose money in the stock market. I'm making the right decision here for myself, but my situation is so different than everyone else's. So everyone needs to consider all the factors and make the right decisions with their financial advisor for themselves. Now, before I go, in terms of a full disclosure, I am long J&J, ticker J&J. I'm long Starbucks, SBUX, and SCHD. Thank you for watching the video today, everyone, and I'll see you in the comments below, and I'll see you in the next dividend stock investing video.